Welcome, hustlers, to another engaging episode of the Full-Time Hustler Podcast. This is episode number 37, and I'm your host, Jason Feimster. Whether you're tuning in for the first time or you've been with us on this entrepreneurial journey, I'm thrilled to have you here today. In this episode, titled Evaluating Revenue-Based Funding versus Traditional Equity Funding, we're diving deep into the world of startup financing. It's a crucial topic for any entrepreneur dreaming of taking their business to new heights. Funding can often seem like a complex maze, but today we aim to simplify that. With the landscape of funding evolving rapidly, understanding the nuances between revenue-based funding and traditional equity funding has never been more critical. Each offers unique advantages and considerations that can significantly impact the trajectory of your business. So whether you're eyeing rapid expansion or looking to steadily grow your enterprise without diluting ownership, today's episode is tailored just for you. But before we dive into the heart of our discussion, a bit about your host, me, Jason Feimster. I'm an entrepreneur at heart with a passion for demystifying the startup culture. Through the Full-Time Hustler podcast, I strive to bring you real-world insights into the challenges and victories of early-stage ventures. Our discussions are rooted in experience, backed by data, and aimed at guiding you through the entrepreneurial landscape. Now let's embark on today's journey, evaluating the paths of revenue-based funding versus traditional equity funding. Stay tuned as we unfold the layers of each, helping you make informed decisions for your business's future. As entrepreneurs, our journey is paved with decisions that can pivot the future of our businesses. One of the most critical choices revolves around funding. How we fuel our growth not only shapes our operations, but also our ownership and control. Today, we're breaking down two prevalent funding models: revenue-based funding, RBF, and traditional equity funding. Let's dive into the essence of each, setting the stage for a deeper exploration throughout this episode. Revenue-based funding, or RBF, is a type of financing where investors provide capital to a business in exchange for a percentage of ongoing gross revenues. The repayment is typically capped at a predetermined amount, often 1.5 to 2.5 times the initial investment. This model aligns the investor's returns with the company's revenue performance, making it a flexible and growth-supportive financing option. What makes RBF particularly attractive is its non-dilutive nature. Entrepreneurs retain full equity in their businesses, avoiding the dilution of ownership that comes with traditional equity financing. RBF agreements are also characterized by their short-term horizons, usually ranging from 3 to 5 years, offering a quicker exit route for both the entrepreneur and the investor. On the other end of the spectrum lies traditional equity funding. This model involves exchanging capital for ownership stakes or shares in the company. Equity financing is the cornerstone of venture capital and angel investment, where investors are not just providing funds, but are buying into the vision and potential of the business. The key advantage of equity funding is the magnitude of capital it can bring to a growing company, alongside strategic partnerships and networking opportunities. Investors in this model are typically looking for long-term growth and are prepared to wait several years for a return on their investment, which may come through an IPO, acquisition, or another liquidity event. While equity funding can propel rapid scaling and expansion, it requires entrepreneurs to part with a share of their company. The decision to pursue equity financing should be weighed against the potential for dilution of control and the pressure to meet investors' expectations for growth and returns. At their core, revenue-based funding and traditional equity funding serve different business needs and founder preferences. RBF offers a less dilutive path to growth, suited for business with steady revenue streams and a desire to maintain control. Traditional equity funding, while potentially more dilutive, can provide the significant capital and strategic advantage needed for aggressive scaling. As we move forward in today's episode, we'll delve into the advantages, considerations, and real-life applications of each funding type. Our aim is to equip you with the knowledge to navigate these choices, aligning your funding strategy with your business goals and vision. Stay with us as we explore the advantages of revenue-based funding in our next segment, illuminating how this model can support your business's growth without compromising equity. In the landscape of startup financing, revenue-based funding emerges as a beacon for entrepreneurs seeking capital without the strings of equity dilution attached. Today, let's peel back the layers of revenue-based funding, exploring how its distinctive advantages can align with the ambitions and values of many entrepreneurs. Imagine this. You're at the helm of a thriving startup. Sales are rolling in, the team is expanding, and the future looks bright. But to scale, to truly evaluate your venture, you need capital. Here's where revenue-based funding shines, offering a pathway to growth that respects your hard-earned equity. Firstly, the hallmark of revenue-based funding is its flexibility. Unlike traditional loans with rigid monthly payments, RBF adjusts to your business's revenue. In months where sales soar, your repayment rate mirrors this success, contributing more towards your debt without straining the business. Conversely, during slower periods, repayments decrease, easing the financial pressure. This symbiotic relationship between revenue and repayment underscores RBF's appeal, particularly for businesses in industries with fluctuating sales cycles. Another compelling advantage of revenue-based funding is the speed of access to capital. In the world of startups, opportunities and challenges arise swiftly, demanding quick financial responses. RBF provides have streamlined their processes, often delivering funds within weeks, sometimes days. This rapid turnaround can be a game changer, enabling you to seize growth opportunities without the weight associated with equity fundraising rounds. Moreover, RBF champions the entrepreneur's desire to maintain control. Traditional equity financing often means welcoming new voices into decision making, sometimes leading to conflicts in vision and strategy. However, RBF investors are betting on your current success trajectory. They provide the funds and step back, letting you steer the ship. This autonomy is invaluable, ensuring that the founder's vision remains uncompromised. But perhaps the most attractive feature of revenue-based funding is its non-dilutive nature. In a startup world, equity is gold, representing the value and future potential of your company. RBF allows you to keep this gold in your vault, untouched. By opting for revenue-based repayments, you're not giving away a slice of your future. You're merely agreeing to share a portion of your present success. This model resonates deeply with founders who have poured their sweat and dreams into their ventures, as it respects their primary ownership and rewards their toil without claiming a stake in their legacy. Finally, RBF fosters a sense of partnership without permanence. Investors in RBF model are aligned with your success, but their involvement has a defined endpoint. Once the agreed upon cap is repaid, the relationship concludes, leaving you with no lingering obligations. This clear horizon is a breath of fresh air in the often ambiguous world of funding, offering a straightforward path to financial independence. In essence, revenue-based funding presents a compelling case for businesses seeking growth on their terms. Its flexibility, speed, control, non-dilutive nature, and finite partnership offer a unique blend of benefits, tailor-made for the modern entrepreneur. As we pivot to the next segment, we'll juxtapose these advantages with the benefits of traditional equity funding, providing a holistic view of startup financing options. Stay tuned as we continue to unravel the funding tapestry, guiding you towards making the most informed decision for your venture. As we navigate the vast sea of startup financing, traditional equity funding stands as a towering lighthouse, guiding entrepreneurs towards opportunities for monumental growth and partnership. It's a journey many have embarked on, trading a share of their company for the capital, connections, and counsel that can accelerate their venture into new realms of success. Let's delve into the core benefits of traditional equity funding, uncovering how it can serve as a catalyst for ambitious growth. The first and perhaps most evident advantage of traditional equity funding is the potential for substantial capital injection. Equity investors, whether angel investors, venture capital firms, or strategic partners, are often prepared to invest significant sums of money. This capital can fuel rapid scaling, from expanding product lines to entering new markets or scaling operations to meet growing demand. In the high stakes game of growth, equity funding can provide the firepower needed to make bold moves with confidence. Beyond mere capital, equity investors bring a wealth of experience and networks to the table. This is where traditional equity funding transcends financial support, morphing into a strategic partnership. Investors often have a vested interest in your success, not just because of the potential financial return, but also due to the personal commitment they've made to your venture. They may offer mentorship, introduce you to key industry contacts, or help navigate the challenges of scaling a business. This access to expertise and networks is invaluable, opening doors that money alone cannot. Another benefit of traditional equity funding lies in the alignment of long-term visions. Equity investors are typically in it for the long haul, seeking substantial returns over several years. This long-term commitment can be advantageous, offering a stable financial foundation upon which to build. Unlike debt financing, where the focus might be on immediate repayment, equity funding allows for a focus on growth and market domination without the pressure of short-term financial obligations. This can encourage more ambitious strategies and investments in innovation, laying the groundwork for significant market impact. Equity funding also has the potential to enhance credibility and visibility. Having reputable investors on board can serve as a seal of approval, signaling to customers, partners, and future investors that your business is worthwhile bet. This can particularly be beneficial in highly competitive markets, where differentiation and trust are paramount. However, it's important to note that traditional equity funding is not without its considerations. Entrepreneurs must be prepared to share ownership and, potentially, decision-making authority with their investors. This dilution of control is a significant factor to weigh, as it can affect everything from day-to-day operations to the strategic direction of the company. In essence, traditional equity funding offers a unique blend of benefits, from significant capital and strategic partnerships to long-term growth support and enhanced credibility. For many startups, these advantages make equity funding an attractive path to achieving their ambitious goals. As we move forward, we'll explore real-life examples of companies that have thrived with both revenue-based funding and traditional equity funding, providing concrete insights into how each financing model has propelled businesses to success. Stay with us as we continue to demystify the complexities of startup financing, empowering you with the knowledge to make the best choices for your venture. Choosing between revenue-based funding and traditional equity funding is a pivotal decision for entrepreneurs. It's a choice that influences not just the immediate future of your business, but its long-term trajectory and the very essence of its ownership. As we navigate through the myriad options available to startup financing ecosystem, let's outline key considerations to help you chart the course that best aligns with your business goals and values. 1. Assess your business model and revenue predictability. Your business model plays a critical role in determining the most suitable funding path. Revenue-based funding, with its repayments tied to revenue, is particularly well suited for businesses with consistent revenue streams. If you operate in the SaaS, e-commerce, or any sector with predictable sales cycle, RBF could offer the financial support you need without the burden of fixed loan repayments. Conversely, businesses with more volatile revenue patterns or those at an earlier stage, banking on future growth rather than current income, may find traditional equity funding more accommodating. Equity investors typically invest in your potential for significant growth, understanding that returns may take time to materialize. 2. Consider your growth ambitions and scaling needs. Ambition fuels the entrepreneurial journey. If your vision involves rapid scaling, potentially to a global audience, Equity funding can provide the substantial capital injection needed to make bold strategic moves. Equity investors often bring more than money to the table. Their networks, expertise, and mentorship can be invaluable in navigating the challenges of scaling. However, if your growth strategy is more measured, focusing on sustainable expansion without the pressure to scale at breakneck speed, revenue based funding can offer a more tailored approach. This method allows you to maintain control over your business's direction, growing at a pace that aligns with your vision and market opportunities. 3. Reflect on your attitude towards ownership and control. How much value do you place on retaining control and ownership of your business? This question lies at the heart of the funding decision. Revenue based funding allows you to keep full ownership and control, with investors taking a back seat once their return cap is reached. It's an attractive option for founders who prioritize maintaining their stake in the company's future. Equity funding, in contrast, involves sharing ownership and sometimes decision making with your investors. While this can lead to dilution of your control, it also opens up a partnership that can propel your business to new heights, provided your visions align. 4. Evaluate the long-term financial implications. Both funding paths have distinct financial implications over the long term. With revenue-based funding, the total cost of capital is generally fixed, providing clarity on the financial commitment from the outset. This can be more cost-effective for businesses that experience rapid growth, as the cap on repayment limits the total amount paid back to investors. Equity funding does not require immediate repayments, easing short-term cash flow concerns. However, the true cost comes in the form of equity given up, which can be substantial if your business grows significantly. This trade-off requires careful consideration, balancing the potential future value of your equity against the immediate need for capital and resources. 5. Future fundraising plans. Your choice of initial funding can influence your options for future capital raises. Equity funding rounds can set valuations that impact subsequent fundraising efforts, while successful repayment of revenue-based financing can improve your company's financial profile for future debt or equity financing. Consider how each option fits into your broader financial strategy and the message it sends to future investors. In conclusion, the decision between revenue-based funding and traditional equity funding is as much about your business's financial needs as it is about your vision, values, and the legacy you wish to build. By carefully weighing these considerations, you can select a funding path that not only fuels your growth, but aligns with the essence of what you're building. As you contemplate this critical choice, remember that the right path is the one that best supports your unique journey as an entrepreneur. In the quest to demystify the pathways of startup financing, we've explored the nuances of revenue-based funding and traditional equity funding. Yet the journey doesn't end with understanding the mechanics of each option. The wisdom of those who've navigated these waters before us can offer invaluable guidance. In this segment, we've distilled expert opinions and sage advice from seasoned entrepreneurs, investors, and financial advisors to aid you in your funding journey. First and foremost, experts emphasize the importance of clarity in your business plan and projections. Whether you're pitching to equity investors or negotiating with revenue-based lenders, a clear, compelling vision of your business's path to growth and profitability is crucial. This not only strengthens your case, but also helps you evaluate which funding option aligns with your strategic objectives. Diversification of funding sources is another piece of wisdom often shared. Relying solely on one type of financing can expose your business to unnecessary risk. As one seasoned venture capitalist put it, think of your startup's financial health as a portfolio. Diversification can provide stability and flexibility, enabling you to navigate the ups and downs of business growth. When it comes to selecting an equity partner, the advice is unanimous. Look beyond the capital. The right investors bring more than money to the table. They offer industry insights, mentorship, and networks that can be pivotal in your company's growth. As one founder shared, our investors have been instrumental in opening doors that would have otherwise taken us years to knock down. Experts also caution against underestimating the psychological impact of different funding types. Equity funding, with its potential for dilution and shared decision making, can alter the dynamics of your business. It's essential to ensure that you and your potential investors share aligned visions for the company's future. On the other hand, the obligation of revenue based repayments can exert pressure on your operational decisions, emphasizing the need for careful financial planning and management. Lastly, the sage advice of prepare for the long haul is echoed across the board. Securing funding is not the culmination of your startup journey, but a stepping stone. Regardless of the funding path chosen, building a sustainable, profitable business requires perseverance, adaptability, and a relentless focus on delivering value to your customers. Drawing from these expert insights, here's a distilled approach to crafting your funding strategy. 1. Self assessment. Begin with a thorough analysis of your business model, growth stage, and financial health. This will help to identify the funding option that best matches your current needs and future ambitions. 2. Research and network. Dive deep into researching potential funding sources. Utilize your network to gather firsthand experience and advice from peers and mentors who have successfully navigated the funding landscape. 3. Preparation is key. Arm yourself with a compelling pitch, robust financial projections, and a clear business plan. Whether you're seeking equity investment or revenue based funding, your ability to articulate your vision and strategy is crucial. 4. Evaluate terms carefully. Beyond the capital, scrutinize the terms of any funding agreement for alignment with your business goals. Look for flexibility, the potential for strategic partnerships, and clauses that could impact future fundraising efforts. 5. Continuous learning and adaptation. Stay informed about changes in the financing ecosystem and be prepared to adapt your strategy as your business evolves. In wrapping up this segment, remember that the path to securing the right funding for your startup is as unique as your business itself. Leveraging the insights and advice of those who've walked this path before can illuminate your path forward, turning the daunting task of fundraising into a strategic stepping stone towards your entrepreneurial success. As we wrap up today's deep dive into the realms of revenue-based funding and traditional equity funding, it's clear that the landscape of startup financing is as diverse as the visionary entrepreneurs navigating it. Each funding path, with its unique advantages and considerations, offers distinct opportunities and challenges. Our journey through understanding the basics, exploring real-life success stories, and digesting expert advice is aimed at empowering you, the entrepreneur, with the knowledge to make informed decisions that align with your business's vision and goals. Choosing the right funding route is a decision that resonates far beyond the immediate influx of capital. It's about aligning with partners who believe in your mission, understanding the implications of capital structure on your business, and positioning yourself for growth trajectory you envision. Whether you lean towards the flexibility and control offered by revenue-based funding or the substantial capital and strategic partnerships associated with traditional equity funding, the key is to approach this decision with a clear understanding of your needs, ambitions, and the potential impact on your business. As you ponder the insights shared today, remember that the essence of entrepreneurship lies in navigating uncertainty with conviction. The path to success is rarely linear, filled with challenges and learning opportunities that shape your journey. Financing your venture is a significant milestone in this journey, requiring careful consideration, meticulous planning, and a steadfast commitment to your vision. In closing, I encourage you to view financing not just as a means to an end, but as a strategic decision that will influence your company's culture, growth, and ultimate success. Arm yourself with information, seek advice from those who've tread this path before, and choose a funding partner that resonates with your business philosophy and growth objectives. Thank you for joining me on this episode of Full Time Hustler Podcast. Whether you're at the cusp of choosing a funding path or contemplating the next phase of your entrepreneurial journey, I hope today's episode has shed light on the intricacies of startup financing, empowering you to make decisions that pave the way for success. Until next time, keep hustling, stay inspired, and remember, the journey of entrepreneurship is as rewarding as the destination. Here's to your continued success on your terms.